Okay, on my last market outlook, which was on the 24th of September, I previewed this document, the UBS Global Real Estate Bubble Index, and we'll go through it a little bit more. I think the first thing that we should do is look at how they define what a bubble is. So we'll just go down here because everything centers on that. They do have later on in the PDF, I think there's a 2-page synopsis on their methodology. And whenever anybody says, okay, well, we're measuring something and we're calling this this and we're calling this that, you want to go to the methodology and say, well, by what measure are you calling it that? Price bubbles are a recurring phenomenon in property markets. The term bubble refers to a substantial and sustained mispricing of an asset, the existence of which cannot be proved unless it bursts. But historical data reveals patterns of property market excesses. Typical signs include a decoupling of prices from local incomes and rents, and imbalances in the real economy, such as excessive lending and construction activity. So we're going to see later on two of these. They have detail on two of these, the income and rents. So let's look at what we have here. 25 cities. Last year, there was like 7 or 8 in bubble risk territory. Now there's only 2, Zurich and Tokyo. And some of the other markets in yellow here are overvalued, and the green markets are fairly valued. In case you're wondering, look at New York and Boston. Fairly valued. Dubai, Singapore, fairly valued, and we'll pay attention to those because I was looking at property in those 2 markets. Sort of an executive summary here. Fewer cities at bubble risk. Tight financial conditions. Financial affordability of housing has collapsed as mortgage rates have roughly tripled since 2021. Therefore, household leverage has been declining in most countries in recent quarters. So what this means is that because affordability is out of reach for many people, because of the high level of mortgage rates, many people are opting not to. Hence, they're not taking on that debt. Not only that, existing homeowners are not upgrading to larger homes. Maybe they're staying in their starter home longer, which means they're not taking on larger amounts of debt as well. They're paying down or amortizing their existing mortgage so that the household balance sheets have been deleveraging over time. Combine that with inflation as a game changer here. Incomes have been rising at the rate of inflation, while household debt levels have been going down, at least due to mortgages. On average, household leverage has been decreasing because of the amortization of the mortgage and the increase in incomes. Inflation made a decisive contribution to the reduction in imbalances. While rising interest rates put pressure on house prices, inflation supports income and rental growth. Too early for a turnaround. There is more downside in real house prices. That does not mean nominal house prices, it means real house prices. So let's say that inflation is 5% and houses rise by 3%. House pricings rise by 3%. That's a 2% drop in the real price. However, a housing shortage has set the stage for a renewed boom in many cities if interest rates fall. And finally, defying gravity, the most sought-after destinations in recent years are Singapore, Dubai, and Miami, all of them tax-advantaged places. Singapore and Dubai are territorial tax regimes whereby your income in Singapore or in Dubai, your income that is derived from those sources, the only income that's taxed. If your income comes from outside of the country, you do not pay tax. If you can't leave the U.S. for a territorial tax system, you'll head to a low-tax state like Texas or Florida. Singapore, Dubai, and Miami, prices are up as much as 40% and rents 50% higher than 2 years ago. So let's look at some detail here. Formerly in the bubble risk zone, Toronto, Frankfurt, Munich, Hong Kong, Vancouver, Amsterdam, Tel Aviv saw their imbalances decline and are now in the overvalued territory. Singapore and Dubai are fairly valued as well, even though the reputation as geopolitical safe havens has recently triggered a surge in demand for both renting and buying there. And during the period of time that I was looking at property prices in Dubai over a 60 to 90 day period, I did see a lot of house prices go up. I did see the average price per square foot that I was looking at go up. And a lot of listings that were available when I started my search, by the time I was near the end, were no longer available. And I kept emailing the agents out there saying, are there any listings you can show me that actually exist? Because most of the listings are for properties yet to be built, for developments yet to be built. So they were pre-selling for the fall of 2024, spring of 2025. So I wanted to know if there was anything that was actually available anymore. Didn't get any good answers to that. Annual nominal price growth in the 25 cities analyzed has come to a standstill after a buoyant 10% rise a year ago. In inflation-adjusted terms, prices are even 5% lower now than in mid-2022. So this is saying, given the drop in prices and the rise of inflation, if you had $1 million house and you had 5% inflation, it should be $1,050,000. So if it only stayed at $1 million, you would say that real property prices have dropped, even though the nominal price of the house has remained unchanged year over year. In inflation-adjusted terms, it has dropped. In Frankfurt and Toronto, the two cities with the highest risk scores in last year's edition, real prices tumbled by 15% in the last 4 quarters. So I've highlighted some here. There is Miami in terms of a bubble index, just sitting at 1.38, right under the 2 that they cite as being in bubble risk. Toronto at 1.21, Vancouver at 0.81. Which is sort of dropping down to approach the level of what you would consider fairly valued. Anything over 0.5 is overvalued. 0.5 to 1.5, this is 0.81. One being in the middle of that range. Vancouver is under that amount, still in overvalued territory, but in the first half of the overvalued territory. Tell that to someone in Vancouver. New York, Singapore, San Francisco, Dubai sitting down here at 0.14. Still, in Dubai, if you look at the prices that you would pay in Dubai per square foot, it is way better than what you'd pay in places like Vancouver and Toronto. But still, from the time I started looking, I saw prices go up dramatically and properties disappear. So 0.14. Let's look over here. The sharpest rise in rents were recorded in Singapore and Dubai. If you look at all the territorial tax systems, Singapore and Dubai are the most developed of all the territorial tax regimes. The most developed. It does not surprise me, given the rattling of more left-leaning governments in Western democracies for higher and higher taxes, and the clarion call that the rich aren't paying their fair share. Oh, they are. It's just something politicians say. It doesn't surprise me that you're going to have capital flight. Those who can leave will leave. I'm a case in point. I'm moving to Costa Rica in January of 2024 because I've just had enough of it. And I know more taxes are coming. And different types of taxes. And I know that the most successful people in this country will bear the brunt of the higher taxes. I know it, so I'm leaving now. If you raise your tax rates high enough, you will actually collect less revenue because you will have capital flight. When I read this, it didn't surprise me at all. Sharpest rise in rents, Singapore and Dubai. In the wake of general inflation, nominal household incomes have continued to grow at a solid pace compared to the previous decade. And as mortgage lending growth halved in the last 4 quarters, aggregate household debt to economic output has been declining, especially in Europe. Not so in Canada. In the US it has, but not so in Canada. This is an interesting chart. We'll go back and we'll read some more in a little bit here. The gray bar is the last 4 quarters. This blue stick here is the last 5 years, and we're looking at residential real price growth as of the second quarter of 2023. Look at Dubai. In the last 4 quarters, somewhere around 15% real price growth compared to the last 5 years of just slightly over zero. New York, again, versus being slightly less than zero. Miami, still positive, not as much as it was in the last 5 years. You can see Vancouver here. This is the negative 10%. This is real price growth, negative 10% versus basically flat. And Toronto way down here, which was somewhere around 4 or 5%, to be somewhere around negative 15% in real terms. Kind of impressive. Demand shows green shoots, as unemployment rates in all the countries covered have remained well below their 10-year averages. The ensuing high level of job security has partly cushioned the impact of rising financing costs on housing demand. Now that's an important sentence, I think. So I'm going to unhighlight that so we know where we left off here. So we are no stranger to the unemployment rate in the United States, well under 4%, with interest rates at 5.5%. And home builders on fire, or at least they have been on fire for most of the year. So what this is saying is that that level of unemployment being so very low has cushioned the blow to these high housing prices. Now, and we know that there is a bear steepener going on the long end of the yield curve in the U.S., if these higher rates at the margin start hurting companies who then start laying off, and you get a cascade effect from that, suddenly you don't have that anymore, that high level of employment. You don't have that anymore protecting property prices. Maybe that happening, unemployment rising at a rate faster than the central bank would like, will cause residential real estate problems. Maybe that will, because, let's read this again, unemployment rates in all countries have remained well below their 10-year averages, ensuring high level of job security partly cushioned the impact of rising financing costs on housing demand. But inflation-driven income growth and price corrections have not been enough to meaningfully improve affordability. On average, the amount of living space that is financially affordable for a skilled service worker is still 40% lower than before the pandemic began. So before the pandemic, what you could get for 1,000 square feet of living space, that same affordability now only gets you 600 square feet, 40% lower. More downside in prices, at least in real terms, is likely if interest rates remain at their current elevated levels. Housing remains undersupplied in most cities, as hybrid working has not weakened demand for city living in a sustained manner. In places where the number of building permits has been declining significantly in recent quarters, most notably in European urban centers, the housing shortage will likely intensify even more. Hence, housing demand is piling up, and prices may soar again as soon as financial conditions for households improve. And then we have some regional focuses. So you have Europe. I'm going to just stick with closer to home here, United States, and we'll do something on Canada. As a result of the sharp rise in mortgage rates and record low affordability, housing demand has weakened significantly in U.S. cities we analyzed. But income growth, a lack of available for-sale inventory, and a strong labor market have prevented a meaningful correction in home prices. And it is this lack of available for sale inventory from two sides. Number one, from existing home sales, because you have that lock-in effect with low interest rates. Homeowners are saying, well, let's just sit here for a while at our 3% mortgage. Why sell and get into a bigger house at a 7% mortgage? Also, home builders, if you have gone through their 10Ks and their 10Qs, have also lowered the level of inventory that they carry. They're less willing to build homes, spec homes, because they have to carry it at the current financing costs. A lack of available for sale inventory, strong labor market have prevented a meaningful correction in home prices. And I think this is a big one right here. A strong labor market has prevented a meaningful correction. That if you suddenly get a weak labor market, will you have a significant correction in home prices? Housing prices in Miami continue to increase faster than the nationwide average. New York is in the middle of a strong comeback following the market's significant weakness during the pandemic's lockdowns. San Francisco. I put San Francisco and Los Angeles here because they have particularly unique problems. San Francisco has been degrading in terms of the quality of the city, just with the sheer number of homelessness and the level of crime that's rising. Same with Los Angeles. It looks like a post-apocalyptic city in many streets, even downtown streets that you drive through, and it's just tents and homeless people everywhere, with crime, especially shoplifting crime, the smash and grab type crimes off the records here, or off the top of the charts, is what I'm saying. The rebound on San Francisco real estate market was short-lived. Since mid-2022, prices have fallen 10% and rents dropped 3% in inflation-adjusted terms. San Francisco is under pressure from quality of life issues, elevated hybrid work patterns, and competition with Sunbelt cities that attract technology companies. Building permits are at their lowest in a decade, but vacancy rates have remained elevated. That is saying that even though you don't have a lot of building permits going on, lowest in a decade, still nobody wants anything. Vacancy rates have remained elevated. San Francisco being part of California. I don't know why they just don't say it has a tax problem. And there is capital flight from California to Texas. Los Angeles. Los Angeles is suffering from a broad loss of economic, and this is an interesting word, competitivity. Normally I'd think it would be competitiveness, but okay, I've never seen it used that way. From a broad loss of economic competitiveness, I'm going to say it my way, due to its significant exposure to the technology and entertainment sectors, quality of life challenges, adverse tax legislation, and high costs of living. At least they say it. Say it. It's taxes. Taxes will drive capital away. Let's see what we have here. Canada. Combination of strong population growth, primarily from immigration, by the way. Here's an interesting fact. Canada has 5 new immigrants entering the country for every one single apartment unit that's created. 5 coming in for every single new apartment unit that is created. Think about the pressure that puts on rents and housing. Attractive financing conditions. I don't know where you're getting that. Attractive financing conditions. High investment demand and an urban supply shortage have fueled the housing bonanza in Vancouver and Toronto for almost a quarter of a century. Okay, well, I guess if you're going back a quarter of a century, that has been true. In such a heated market environment, it doesn't take much for sentiment to change quickly. A mix of increasing financing costs and higher mortgage stress test rates tip the scales. Outstanding mortgage growth in Canada has slowed to the lowest level since the beginning of the boom in 2000. Price levels in Vancouver and Toronto have corrected by more than 10% in inflation-adjusted terms since mid-2022. As demand for living space in these cities is rising steadily, the pressure is shifting to the rental market. In Vancouver, rents have climbed around 10% compared to a year ago, while they are a good 5% higher in Toronto. Both cities were showing signs of housing market recovery in the spring with increasing numbers of transactions, positive price growth. Nevertheless, it is premature to speak of a turnaround against the backdrop of recent interest rate hikes from the Bank of Canada. And I follow some of the REITs, apartment REITs in Canada, and they all had great earnings. NOI growth of some as high as 13-14% NOI growth year over year, simply because where are you going to go? We have way more immigrants entering the country than there is housing available for them. There is no place to go but squeeze in to these apartments at whatever market rent these apartment buildings want to charge. And in the spring, you even had bidding wars showing up in Toronto again. That doesn't exist now. We're in the fall. That's sort of gone now. But bidding wars looked like they were making a comeback. We'll go past this. Middle East, with housing prices sliding for 7 straight years. The market for owner-occupied housing in Dubai started recovering in 2021. The risk score dropped significantly over the course of this 10-year period. In the last 4 quarters, housing prices increased by a double-digit rate. Given strong income growth and a red-hot rental market, with rental growth even surpassing owner-occupied price growth, we see the market as fairly valued. While Dubai is highly cyclical and prone to overbuilding, price momentum should remain strong in the coming quarters. And there is a spotlight on Dubai on page 21. We'll read a little bit of that. Here's one of the fundamentals, price to income. Buying a 60 square meter or 650 square foot apartment, there is, I think, 10.88 square feet per square meter. So if you take the 60 and multiply by 10.88, you get somewhere around 650. Apartment exceeds the budget of those who earn average annual income in the skilled service sector in most world cities. and that's about 100,000 a year in Canada. Unaffordable housing often signals strong foreign investment, tight zoning, and strict rental market regulations. Weakening investment demand increases the risk of a price correction and weighs on long-term appreciation prospects. This is an interesting chart. The number of years a skilled service worker needs to work to be able to buy a 650 square foot flat or condo or apartment, depending on the language that you use, near the city center. So just to be clear, it is near the city center, so that's prime. You can always get it cheaper if you're out in the suburbs or a little away from the city center. But in the city center, look at Hong Kong, 23 years. Here's Toronto down here at about 6 years. So if you have about $100,000 income, probably cost you about $600,000, $700,000 to get a condo near. Not in, near the city center. 650 square feet. That's not a lot. Okay, that's not a lot if you think about it. Miami, 5 years. Where is Dubai? Dubai here is pretty much on par with Toronto. Vancouver, 7 years. New York's about 8 years. Singapore, 10 years. But look at Hong Kong. Price to rent. Almost a third of the cities covered have price to rent multiples above or close to 30. That is a cap rate of around 3.3%. At 30, you have a cap rate of around 3.3%. You can get a 10-year U.S. Treasury that has a yield better than that. And a 10-year U.S. Treasury doesn't need a new roof, doesn't need the lawn cut, doesn't need a paint job, doesn't have any depreciation, doesn't have any wear and tear. And you can do better in a 10-year Treasury than some of these cities that have cap rates at 3.3%. Such high multiples come from an excessive appreciation of house prices in the wake of previously low interest rates. House prices in all these cities remain vulnerable to correction should interest rates remain elevated for longer or continue to rise further. U.S. cities analyzed in the study exhibit some of the lowest multiples among the markets analyzed. These reflect, among other things, above average interest rates and relatively mildly regulated rental markets. Conversely, rental laws in France, Germany, and Sweden are strongly pro-tenant, keeping rents below their true market levels, as reflected in high price-to-rent ratios. So what we can do here is, for the number of years, look at Tel Aviv at 42 years. Take 1 over 42, and that's your cap rate. So 1 over 42, that's less than 2.5% cap rate. Very at the very bottom, Miami, 15 years. Dubai, 15, where is it? Yeah, that's 15 years. 1 over 15 is 6.67. So cap rate's under 7%, but over 6% compared to U.S. Treasury. That's about 200 basis points higher on a cap rate. You would think, well, if I buy 5 or 6 condos, it's still worth it for me to do that as an investment over a 10-year Treasury. You get to Toronto with a little over 20 years, 21 years. You're under a 5% cap rate. That's tough competition with Canadian 10-year bonds. And then it just goes up from there. But think about some of these markets. Think about cap rates that are 2.5%. Super low. City spotlights. We're going to look at just a few of these. Where are we here? Singapore. Singapore's private residential market continues to benefit from the city's safe haven reputation amid geopolitical tensions, attracting expats, wealthy investors, and new businesses. Because of the territorial tax system, it does not surprise me that Singapore was doing well. Housing market cooling measures introduced in recent years are starting to take effect. Stamp duties for foreigners have been raised to 60%, the highest globally, significantly curtailing foreign demand. Dubai, lots to say here. The 7-year-long drought of falling real estate prices has become a distant memory. Prices have been booming since 2021 and increased by 15% in inflation-adjusted terms between mid-2022 and mid-2023. Add 5% inflation to that, that's saying nominal prices up 20%. The highest growth rate among all cities analyzed in the study. Price increases in the luxury segment were even stronger, as much as 50% higher, by the way. Dubai has attracted real estate investors globally. A new visa program with looser residency requirements aimed at wealthy and skilled individuals, no personal income tax, and early lifting of travel restrictions during the pandemic have stimulated immigration. So I buy a house over a certain dollar value in Dubai, I get a 5-year visa, extendable for another 5 years as well. So that's what it means, looser residency requirements, no personal income tax. That's a huge thing. And I think going forward, and the reason I want to single out Singapore and Dubai, as I said earlier, territorial tax systems, most developed territorial tax systems, I think this will be a growing trend going forward. You have, and I'm just going to pick on Canada and the US, excessive amounts of debt that has to be paid. It has to be paid at some point. And you have governments that seem to want to run deficits as far as the eye can see, with almost either an unwillingness or an inability to recognize the debt level is problematic. Just whistling past the graveyard, it seems. Well, every single penny a government spends has got to come from you somewhere, whether it's going to be higher tax rates, more taxes, service charges, less services offered. They're going to come after you somewhere. And really, the bottom 50% of income earners don't really have the income to tax, so probably not going to tax there. If you have more liberal, democratic, or left-leaning governments, well, they don't like going after the middle class either. So who do you think they're going to go after? They're going to go after capital. They're going to go after capital. You're already seeing the Biden administration wanting to tax share buybacks with the argument of why should capital be taxed less than labor? So it's a 1% tax on share buybacks from companies. They're not going to stop there. They're not going to stop there. The capital gains tax, which is favorable. Again, why should capital be taxed less than labor is the rallying cry of the left. They're going to go after that. They're going to go after capital. So it is not shocking to see that those regions that do away with those taxes are seeing an inflow. And they do mention it because it is a thing. No personal income tax, that is a thing. Consequently, residential transaction volumes have gone through the roof. Again, Dubai have gone through the roof, breaking all-time highs. Nevertheless, inflation-adjusted prices are around 25% below their 2014 peaks. That's inflation-adjusted prices, right? That is not nominal prices, but inflation-adjusted prices. Furthermore, as many newcomers rent before potentially buying in the future, rents have increased by 20% in inflation-adjusted terms over the last 4 quarters. As a result, the market remains in fair value territory in our view. We expect weakening momentum in the coming quarters, although the market is largely financed by cash purchases. Increased mortgage interest rates will take their toll. An ongoing strong expansion of supply, particularly of apartments, is also likely to limit price growth. Finally, buyers' willingness to pay may abate against the backdrop of a global economic slowdown. I think maybe you might get a period where it slows down, or a period where the growth in prices goes sideways for a while. But I think if you project out over the next 5 years, no, I think capital is going to want to get the hell out of the way of higher taxes that inevitably must come. Either you're going to have government austerity, which I don't see happening because it's political suicide, and politicians aren't there for you, they're there for themselves. They're there to get reelected. That's what they're there for, to perpetuate their own job. They're not going to take the courageous way out. They're going to take the cowardly way out and just tax. And of course, they'll tax the evil people in society, which they call the rich people. They'll tax success. They'll tax the capital. So I don't see it ending. In fact, I see it probably resurging, and probably a big discussion among countries globally about these territorial tax systems, that they will start to see it as unfair and demand some kind of minimum tax on them. But for now, I don't see this. I don't see this being something that just was a post-pandemic thing and that's it. This is interesting, city overview, and you have all of the sub-indices here. So this is the total, this is the score, this is the assessment. You see Zurich 171 in bubble territory, and then it gives you the sub-indexes to see where they happen to be. Two of them are fundamental, two of them are relate to the level of construction, the level of mortgage rates. These two columns here, you have real price growth annualized in the last year versus the last 10 years, and this is rent in the last year versus the last 10 years. Have a look at Dubai down here. Real price growth 14.6 in the last 4 quarters versus negative 0.1 over the last 10 years. Rental growth 20.3. This is in real terms now. Real terms. So you have to add inflation for a couple of years, or at least for the last 4 quarters onto this to get to nominal. 20.3%. Look at Singapore, 23% in terms of rental growth. Vancouver, 10.7% in rental growth. Housing prices dropping in real terms, 10.6%. So there's a lot to go through in here that's rather interesting. And then you have your methodology and data. This is where you can go through and they talk about how they come to their conclusion of saying bubble risk. And earlier, remember, they said they're not going to know it's a bubble till it bursts, but they don't say it's in a bubble. They say it faces bubble risk. And then your data sources if you want to go a little bit further. It's an interesting read. And there we go.